Good afternoon, everyone. Thank you so much for joining us today on Tuesday afternoon, January 3rd, for the latest readout of Spectrum Group's Affluent and Millionaire Investor Confidence Index data. We're also going to be reviewing some of the key findings from a recently published report entitled Financial Wellness in Retirement. My name is Randy Wostrowski, a director here at the Spectrum Group. Hope all of you who are with us today had a wonderful holiday season and a great new year. I'm joined by Spectrum President George Walper, who will be starting today's webinar off by going through all the recent data from year-end 2016 regarding our two confidence indices, and then I will discuss some of the key findings from that financial wellness in retirement research. Please note that there is a section on your screen where you can type in questions. If there's anything you would like to ask George or I throughout the duration of our presentation, please do type into that question box area and we will answer them in the order that they are received. So without further ado, I will turn it over to Spectrum President George Walper. George?
Thanks, Randy, and Happy New Year to you all. Thanks for joining us. December is a very interesting month for the index. It's obviously the first month post, a full month of post-election. Last month was pretty interesting relative to where our research found wealthy investors' opinions about a number of factors. We'll take a look at that again. In terms of various topics we'll talk about, as Randy said, I'm pretty excited about the last part of today's webinar, and that is the research that Randy will touch upon, research that we did last year with three different groups of retirees. Those who've been retired 10 years or less, those 10 to 15, and those retired, 10 to 20, and those retired 20 years longer. There's been a lot of research done over the years with pre-retirees and new retirees, but we wanted to spend some time talking to people both in focus groups and quantitative research that have been retired a number of years, but including 20 plus, to find out how it really is. Because every time we talk to retirees who have been retired 10 years or less, they're very happy. And that's great, but we also know that that doesn't last forever. So I'm excited. Randy and I will talk a little bit about that. But let's take a look at what our index did this month. And as a refresher, we have two different levels of indices of wealthy Americans. Those, the millionaire, which is $1 million plus of net worth, and then our affluent, which is 500,000 plus. We take a look at a number of different factors, how they invest, what their attitudes are about the economy, their household, etc. At the highest level, the two indices we show here, just a little bit of trending. Compared to last month, the millionaire index was down 2 points and the affluent was down 3 points. So that essentially, for all practical purposes, is pretty flat. And similar to compared to a year ago, where you can see that's essentially equally flat. I would say for this month, I think that's a relatively good news, is that after the energy in November, and we'll see November's numbers here in a second, that this month pretty held at the same level. We'll see that a little bit more in terms of as we have throughout 2016, and we'll decide in 2017 how we're going to report various folks' political affiliations in terms of how their political feelings influence these numbers. So you can see the top number here is the past 12 months of millionaire, and then the orange-ish color is the affluent overall. You can see the trend, but the last 2 months trending upward and then down, basically flat this past month. And then you can see down below the trailing many, many years back to 2004 when we started our two indices. One of the key components we feel that we want our clients, advisors to look at is what we call the affluent household outlook. And that's measures a number of factors. We'll go through those here in a moment. But to me, it's the true test, along with how people say they're going to invest, is a true test of how people are really feeling. And you can see some pretty significant trend upward since October, really the 2 months post-election. The November number jumped rapidly, or significantly rather, and then November held in there pretty well. I think these are important numbers. They're important because it's an overall sense for what wealthy Americans are thinking. So let's look at some of the subcomponents. The overall outlook, as I said, is up compared to last month and significantly compared to October, but more importantly, even up compared to a year ago. The subcategories we look at are household income, how people feel about the income of their house the next 12 months or so, the economy overall, their company health, either companies they own or their employer, and then their overall household assets. Now, the economy is an interesting one because that's the one throughout last year that, based on folks' political affiliation, had a significant difference of opinion. But all these numbers are trending significantly upward last month as well as from a year ago. And clearly, and for those of you that were with us last month, from 2 months ago in October. So here's where we found throughout last year, we continue to see the significant difference in terms of what people think about outlook-wise based on the three categories that we asked their political affiliation: Republican, Democrat, or Independent. Now, this particular month looks somewhat similar to last month, where you look at the economy line. The overall economy, when we looked at the previous page, was 17.6. But here's where you see the significant difference between Republican, Democrat, and Independent. For the last 2 months, the Republican numbers have been very, very high, similar to these numbers. Democrat numbers have been quite low. Independents have been in the middle. Now, throughout last year, every month, January through October, the Republican and Democratic numbers were almost identically flip-flopped. Where Democrats last year were all extremely optimistic about the economy, Republicans were not. The moment the election results came out, these numbers flip-flopped, and they remained at that kind of a significant difference. Independents have been in the middle, sometimes a little closer to Republicans, sometimes a little closer to Democrats, but the economy is significantly different in terms of people's attitudes. The other numbers in terms of different categories are similar by political affiliation. You'd expect a difference, but nothing as dramatic as their perception of where the economy is going. I'm sure we will track this number. We always research based on political affiliation. We just don't report it out, but we decided to in 2016. I suspect we'll continue to do this in 2017, especially on this outlook, because it is so different by party. We always ask a series of different types of questions. Last month, the most serious threat to their household goals. The top two categories being the political climate and the overall market conditions, which is kind of interesting that the markets there, given the markets at an all-time high, and continues to do well going into today, I think. At least it opened up strong. And so this is one that we'll ask the same question again in 3 months, so we'll see what kind of reaction we get. You can see the trend here over the past 6 quarters. We always like to look at things sort of over time, but market conditions are high compared to where it's been. But I think that's people are concerned about, will it start to drop as we go into this year and things settle down, hopefully settle down. Another key element of our index, and we think one that advisors who participate in these calls and receive our newsletter as well as providers, is how are people going to invest? So here you have equities, fixed income, short-term, and real estate. The past 12 months, this is how people are going to say they're predicting. They're relatively somewhat concerned, I think, at some level about putting more money into equities, given what the market is in terms of buying it at all-time highs. Similar to bonds, you're starting to see some of that either flatten out or track downward, given interest rates rising, and what that will mean for medium and short-term bond markets. And then those folks that say they're going to go into stay in cash, and then real estate, which dropped back in September, is kind of flattened out. We think those are all important categories when advisors are meeting with clients and talking to clients about what they're thinking about investing in. Now, we look at the same investment categories by political affiliation. You see somewhat similar stock mutual funds, a little different for Democrats, but individual stocks are the same essentially. And then each of these categories, even though we talked a lot about folks having a strong opinion about the economy relative to their political affiliation, their attitudes about investing are not that significantly different. You always will have a difference of somewhat based on equities versus fixed income, and then individual securities versus mutual funds. But these are all pretty similar relative to their political affiliation. So we'll continue to monitor this a month from now in terms of what happens throughout January. I think you'll see a lot of impact in terms of how the media covers what's happening in Washington, because the media, how they cover this has a pretty significant impact on what these folks think. So now we're going to spend a little time, as I talked about earlier, into the newest study, which we released right before the holidays and have not released it to the market until this week. The study that Randy will talk about in terms of financial wellness.
And thank you, George. So we just recently released this particular study on financial wellness in retirement. And conceptually, financial wellness is really something that has kind of come into the financial services vernacular in a pretty aggressive manner over the past few years. And this concept of looking beyond your paycheck or owning a home to the true concept of what it means to be financially well. So beyond just being able to generate income, but to go into things like making sure you have a proper estate plan in place and all the non-stock picking related items that have to do with one's overall financial blueprint. And this report is unique in a number of ways. The first of which is that it is based on both qualitative, in-depth interviews and focus groups, as well as some quantitative online research surveying that we did. So having the hybrid methodology really allowed us to gain some interesting insights with these groups of investors. Additionally, we focus specifically on folks who are currently in retirement and how, based on the length of time they have been in retirement, their attitudes, their behaviors, their concerns, etc., are similar and different. And so we have three distinct groups of wealthy retirees included in this report, and that's those with between 0 and 10 years of retirement, 10 to 20 years, and then those with 20 or more years. And so looking at those groups right now, just from a simple advisor usage standpoint, you can see a lot of the younger folks, almost 3/4 of that group that has been retired from 0 to 10 years, are still currently utilizing the services of a financial advisor. One thing that we kind of learned from doing this work is that there is no one right or wrong way that these folks have gotten to this certain level of affluence in retirement. Some people had done a very good job of preparing. Some did not do it enough or far enough in advance, I should say, and utilize the advisor in that 5 to 7 year retirement range before they hit that number. So that's something that you can see many of those who are still young and who have not been retired for that long still are utilizing the services of an advisor. Looking right now about some of the various approaches that these groups have, overall, you saw that a certain age was still the dictator before determining people who were going to, or pardon me, was the dictator for why people were retiring. You still see a significant amount that say they retired due to events beyond their control, things such as health issues and other. But there's also the asset level. There's a lot of folks that, particularly in that middle range, in the 10 to 20 year range, that said they needed to reach that specific asset level prior to retirement. And you can see the lowest there is that group that has been retired for 20 or more years. So folks that are most likely in that baby boomer generation, many of which probably had a traditional defined benefit plan, that for them it was not reaching a particular asset level. It was knowing the benefits they were going to be receiving for the perpetuity of their retirement, and as such, not worrying as much about a particular number before retiring. Surprisingly enough, you had across the board almost 8 in 10 of all respondents saying that retirement is better than they expected. Obviously, this is something that was quite different when we did similar questions back in 08 and 09, and we saw such a significant part of the market that really reduced folks' net worth and their portfolio valuations. But right now, people are feeling pretty good in retirement, and they are worried a lot less, again, across the board regarding their financial situation and how good it is relative to what they thought it would be. Some folks say they should have retired earlier, and there are a couple that say they still have concerns, the majority of which are in that 20 plus years of retirement. So you're looking at a lot of more health-related issues. Looking at some of the different product ownership here, we do see a strong number of folks across each of the 3 different groups that have a will in place, and also well over half of all 3 groups do have an estate plan in place. And then looking at the long-term care coverage that folks have, it is, again, those folks that have been retired for 20 or more years that are the most significant owners of the long-term care policies. These are some of the qualitative highlights that we've seen, and you all can kind of review these at your leisure. One in particular I wanted to point out was those, and I do apologize for the typo, it should be retired 10 to 20 years. But in that middle section, the top quote in blue, not just encouraging people to save from day one. I think that's a message that financial services as a whole does a good job of sending out there. But talking about those true unexpected expenses that are not the large ones that we're looking at on a day-to-day basis, such as tax implications, such as healthcare issues and things like that. So you can see there tires for the car, a new washing machine, that prescription you have to pay a little bit more for. It's not just those large expenses that people are dealing with in retirement. It's the smaller ones as well that will drive a little bit of that uncertainty. And as we've come to learn, the uncertainty about retirement is something that can really be detrimental to someone's financial wellness, especially in retirement. So helping all of these folks recognize and realize what some of these unexpected expenses are in retirement and how they can then make sure they're affording them without incurring any debt or things like that.
You know, Randy, a couple other thoughts that struck me when we did this research. In terms of what retirees had to say or give advice to folks who have not been retired. The first is, as Randy mentioned before, the percentage that use advisors. We found about 68% are still using the same advisor they used that helped them plan for retirement, or the same firm, depending on the age of the advisor. So that's good from a relationship overall standpoint with their advisor. The other part that's interesting in here is those that have annuities, how they chose annuities, when they chose the annuities, when they purchased, meaning rather than chose. And what folks did, especially those that have been retired in the less than 10 or 10 to 20, what they did with their 401k balances, did they use those money to purchase an annuity at that point? Did they leave it with the provider, et cetera? So it's all quite interesting that you have a nice insights around folks planning for retirement, how they did it, what they've experienced. You do see some significant lifestyle differences, which makes sense. As Randy pointed out, people's health starts to deteriorate at about 15 years to 20 years in retirement, depending on their age. So it's a great report for providers and their advisors relative to how to really help people who are planning for retirement or who are even in retirement, but for less than 10 years, and what it looks like going forward.
And going on to the next slide here is just a highlight of one of the monthly publications that we produce here at Spectrum, and it is our High Net Worth Insights newsletter. Within this newsletter, you will see a lot of the coverage that we publish in our Affluent and Millionaire Investor Confidence Index data, but supplemented with a little bit of commentary around what it means for you as an advisor or a financial provider. We do include some of the retirement research topics that we publish reports on within the High Net Worth newsletter. And this is something that we have a number of folks that we've worked with for a while that going into 2016 kind of came back to us and said, we would really like to see you bulk up the content and the all of the different types of insights and information that you include in this monthly publication. And so we've done that throughout 2016. Look forward to continuing that trend here in 2017 as far as taking that publication, which used to be about 10 pages, usually around 8 to 10 pages in length, and now it's usually upwards about 25 or 30 different pages. So you can see there a little example of what that looks like, and this can be delivered through both PDF as well as through an electronic, more interactive delivery service that we use for these insights. So please don't hesitate to reach out if there's any interest in learning more about this particular monthly newsletter. At this time, I'd love to open it up to any particular questions that the audience may have. So please feel free to type in those questions if you have them right now. It doesn't seem like we have any follow-up questions at this time. So once again, I do just want to say thank you all to joining us today. We appreciate your time. We wish all of you a wonderful 2017. And as always, please do not hesitate to reach out to us here at Spectrum to discuss any ways that we can be an appropriate resource for you throughout the year. Thank you again. Have a great afternoon.